Growing weakness in America's $20 trillion commercial real estate market may be the catalyst of the next round of banking turmoil. Signs of possible distress are starting to emerge in the financial system. As they do, investors are reminded of the strategic role assets like precious metals have played in hedging against risk. Economic uncertainty means you have to keep up with what's happening. Make sure you subscribe and we'll keep you in the know. Recently, we had a preview to what many analysts fear could be a seismic banking system event triggered by weakness in the commercial real estate market. Regional bank New York Community Bancorp reported suffering an unexpected $252 million loss last quarter, due largely to its struggling commercial real estate loans. The bank said it was forced to expand the amount it sets aside to cover loan losses from $62 million in the third quarter to $552 million in the fourth quarter, an increase of nearly 800%. The fallout for the lender has been swift and included a 60% deterioration in the bank's stock price, which has since moderated only slightly. Commercial real estate has been a growing risk factor for lenders ever since technology-driven changes in how we live, work, and shop have emptied office buildings and retail spaces at an alarming rate. According to Moody's Analytics, the average vacancy rate of office space in major U.S. cities right now averages nearly 20%, with some cities, including Denver, Detroit, Houston, and Seattle, at or near a 25% vacancy rate. Intensifying the pressure is the fact that a large portion of commercial real estate loans will be maturing in the coming years and refinanced at higher rates. This could be especially bad news for regional banks, which, when it comes to the commercial real estate market, are America's too big to fail banks. That's because while U.S. banks overall are holding $2.7 trillion in commercial real estate loans, about 80% of it is held by the smaller regional institutions like New York Community Bancorp. And of that $2.7 trillion, roughly $2.2 trillion comes due between now and the end of 2027. According to TREP, a commercial real estate analytics firm, David Avaram, principal at Maverick Real Estate Partners, said recently, "The percentage of loans that banks have so far been reported as delinquent are a drop in the bucket compared to the defaults that will occur throughout 2024 and 2025. Banks remain exposed to these significant risks, and the potential decline in interest rates in the next year won't solve bank problems." Last week, German lender Deutsche PBB, which has a 15% portfolio exposure to the U.S. commercial real estate market, said the current conditions in that market represent the greatest real estate crisis since the financial crisis. A recent study by Sprott Asset Management determined that throughout 7 crisis periods over the last decade and a half, including the global financial crisis, gold on average outperformed popular mainstream assets by a significant margin. As expected, both gold and silver remained strong as last year's turmoil in the regional banking sector unfolded. From the closure of Silicon Valley Bank last March through the downfall of First Republic Bank at the beginning of last May, the price of each metal soared by double-digit percentages, prompting commodity strategist Bart Mellick of TD Securities to declare gold looks very much like it is fulfilling its mandate as a safe haven. You and I don't know what will happen next, But there is something we probably agree on, that anything can happen and we should probably be prepared. Given the stakes, it might be wise for investors to learn how gold and silver can diversify their portfolios amid new concerns about the stability in the banking system. That's why I suggest you take the time to learn more about what's really going on in the economy by attending our exclusive one-on-one web conference at AugustaPreciousMetals.com/webconference.